In this section, we're going to talk about something that you may not have yet considered: who actually owns most of the stock market. Many people imagine millions of small investors, each holding a tiny slice of the market. That's partly true, but the bigger picture might surprise you. In the United States, individual investors collectively own only about 20% of all stocks. The majority, roughly 80%, is owned by big institutions such as pension funds, which invest on behalf of workers saving for retirement, mutual funds, which pool money from thousands of small investors, and hedge funds, which are private investment firms that often take large, strategic positions in companies. These institutions manage enormous amounts of money and therefore hold very large stakes in many companies. Why do these institutions matter? Because these big players own so much stock, their actions can have a huge impact on the market. When a large pension fund buys or sells millions of shares, it can move the stock's price. They also have a say in how companies are run. With significant voting power, institutions can influence decisions on company strategy, executive pay, or even whether a company merges with another. It's not just individuals and institutions who invest. Companies themselves sometimes buy other assets. A well-known example is Tesla, which purchased about $1.5 billion worth of Bitcoin in 2021. This shows that corporations can act as investors too, putting some of their cash into stocks, bonds, or even cryptocurrencies to diversify or pursue strategic goals. When we talk about ownership, one important concept is the majority stake. Owning more than 50% of a company's shares gives you effective control. It means you can influence or even decide key decisions, such as appointing board members or setting company policy. This is why large shareholders, whether they're individuals like company founders or big institutions, can have a lot of power in shaping a company's future. To understand the scale of ownership and investment, you'll often hear the term market capitalization, or simply market cap. This is how we measure the total value of a company's outstanding shares. The formula is simple. Number of shares times stock price equals market capitalization. For example, if a company has 100 million shares and each share is worth $20, the market cap is 100 million times 20 equals $2 billion. That $2 billion represents the market's total valuation of the company at that moment. So why does this matter? Knowing who owns most of the market helps you understand how stock prices move and why big investors often set the tone. It also reminds you that when you buy stock, you're joining a vast ecosystem, one where small investors, giant funds, and even companies themselves all interact. Understanding market cap, majority stakes, and institutional ownership helps you see not just the how of investing, but the power dynamics behind it. So while individuals like you and me play an important role, the stock market is largely driven by big institutions and sometimes even corporations. Next, we'll talk about why this matters for your own investing strategy and how you can navigate a market dominated by such powerful players.